Callahan. I have the honor of being the head of the construction industry practice here at CohnReznick, and I will be the moderator for today's session. I have more than 30 years experience in public accounting, tax and consulting experience in the construction industry. It's revolving around corporate taxation, business consulting matters within the construction industry, and very proud of my role here at CohnReznick and the amazing people that I get to work with on a day-to-day basis. I'd like to take a minute and introduce our speakers for today. Our first speaker will be Richie Back. Rich is a director at CohnReznick and a member of the firm's tax practice. He has extensive background providing tax services for clients in multiple industries. In addition, his expertise includes tax planning, consulting, and IRS examination support in connection with accounting methods issued, including timing, UNICAP, LIFO, Section 199, and the repair regulations. Our second speaker will be Jesse Wutke. Jesse is a senior manager in our Sacramento office in the research and development group for CohnReznick. Jesse has extensive experience providing services for clients in multiple industries, focusing on the research and development tax credit. He's assisted clients with IRS and state audit matters. Throughout his career, Jesse has gained valuable experience representing clients before taxing authorities. Our final speaker in today's panel will be Steve Nanos. Steve is the Executive Vice President with Walker Reed Strategies and a lead Green Associate. Steve and Walker Reed have certified more than $1 billion in 179D tax deductions. Steve brings more than 35 years of experience in energy, environmental, HVAC, and building construction, with specific focus on assisting architects, engineers, design build contractors, and building owners in specifying green energy efficient equipment and systems for the manufacturing facilities, schools, hotels, offices, and warehouses. As we begin this seminar, I want to go over certain basic guidelines. We encourage you to submit questions. To do that, please use the Questions tab in the panel on the right side of your screen. We'll be answering all questions at the end of the presentation on this, unless there's something particularly relevant. However, please feel free to answer the questions as you go. This way we'll be able to track them and keep them lined up for Q&A at the end. For those looking for the CPE credits for this webinar, please be sure to answer at least 75% of the polling questions within the presentation. Again, participating by answering the questions is far more important than the accuracy of the questions. So the questions are just to keep you involved and give us some perspective on the viewpoint of the folks that are participating in this seminar. An email including the CPA certificate will be sent to all participants who've answered 75% of the polling questions shortly after the completion of this session. We'll be also sending a copy of the presentation along with some additional information to all those who have registered as attendees for this event. So now we'll move on to our presentation. It'll be a 1-hour webinar. We hope that our clients and prospects and construction executives will get a high level of understanding of the updates to the tax rules relating to the treatment of fixed assets for tax purposes, rules around Section 179, as well as the research and development tax credit. I think we're all in the construction industry, and certainly us as accountants servicing the construction industry, have been very frustrated. In the last 4 to 5 years, we have not had tax legislation passed until December or January of the subsequent year. Finally, this year we've got some advance notice. We have tax legislation that's in place, which will give us a full year to do some planning. As you've wrapped up your year-end financial statement audits and getting through your year-end tax returns, start to do planning for this year. And we hope that having tax laws that we can actually look to and plan around will give you the chance to talk to us and talk to your tax providers to really do some strategic organization before the end of the year. So on that, Rich Back, why don't you take off on your presentation? Thank you, everyone.
Thanks, Jack. So the first thing I want to do is just introduce myself a little more. I know Jack talked about me. My name is Richie Back. I'm a director in our National Tax Office. We have a group of about 20 people at CohnReznick who are tax experts in specific areas. And for those of us in this group, most of us have either government experience or prior very large firm experience. And you know, the great thing is we have a wealth of knowledge within the National Tax Group, and it's great because we get to specialize in certain technical areas and get into far more depth with our clients than we might otherwise be able to. So that's me. What I want to do today, and the purpose of the presentation, is to give you some updates for some items that came out over the last, I'd say, 6 months to a year. They're going to fall into 4 buckets. The first thing I'll talk about are items that came out in connection with the PATH Act. You know, Jack made a great point. It's been frustrating over the last several years, or many years, when you're waiting at the end of a tax year and you're telling a client or a company, or you're telling your boss, hey, we don't know what we could do yet. We don't know what's going to happen. Congress might come out and extend something retroactively. In particular, last year, when Congress went past December. So it's always very difficult. So I want to talk about what came out this year when the PATH Act was passed. Now, I'll talk about some of it. Jesse will talk about another part of it, and Steve Nanos is going to talk about 179D. All those areas were affected by the PATH Act. The next area I'm going to talk about, just to give you a highlight of where I'm going, are areas covered by, that may be affected if certain budget proposals come to be. So there are several budget proposals that might affect the construction industry, and if they don't affect you, they would affect your clients, so you need to know about them. From there, I'm going to go into an IRS update, talk about certain administrative items that came out this year from the IRS that will affect how you procedurally effectuate some of the things that you want to do. I'll talk about that for a bit. And the fourth section I'll just call other related items. There are some cases and other items that came out this year that would affect contractors, and I'd like to talk about those as well. Okay, so with that, we're going to go into the PATH Act updates.
All right, to start off, we'll start with our first polling question. Make sure everyone's out there and that the interactivity, it works. So our first polling question is, does your company take advantage of bonus depreciation in Section 179? Yes, no, or I don't know. Give us your answer and we'll keep an eye and see how the results come in. Great, it looks like it's working. So overwhelming, almost 70% of those participating here say that companies do take advantage of the bonus depreciation in the Section 179. So, Rich, we've got some folks that are working on this, so let's give them some more information.
It's good that it's good that I picked this topic then. So, bonus is one of those areas that from year to year would be extended for a short period of time, and oftentimes is extended after the year ended. And what that did was it made it very difficult throughout the year. If you think about estimated taxes, or if you have C Corps with provisions, it made it very difficult to operate throughout the year and to know whether you were going to get bonus depreciation. To make matters worse, over the years, you had years where it was 100%, 30%, 50%. So what you need to know here is the PATH Act extended bonus. That's the great news. What you see in the middle of the slide is the fact that this is the but. The extended bonus but. 2016 and 17, we're going to have 50% bonus depreciation, and that's been the case for a while. The way things stand now, in 2018, that 50% would drop to 40%. It would drop to 30% in 2019, and then it would turn off again. So I put a question mark for after 2019, because if we look back at history and the fact that Congress tends to extend things when people get mad enough, there could be a chance down the road after 2019 that Congress would extend that. The bottom bullet point is talking about the fact that those dates and all the placed in service dates and the dates for determining whether you're bonus eligible are extended for 1 year for certain long production period property. So that's a little nuance there that I wanted you to see. So next, what I want to talk about is, this is an important issue that may affect you and certainly will affect your clients that you're doing work for. So in 2015 and prior, the bonus rules allowed you to take bonus on property with a recovery period of 20 years or less, computer software, water utility property, and, quote, qualified leasehold improvement property. So now I'm on the left-hand side of this slide. If you haven't filed for 15, you're operating under those rules, and it's the same as it was in 14 and 13. starting in 2016, Congress created a far broader opportunity, a far greater opportunity to take bonus depreciation. You see on the right, the top right-hand side of the part of the slide, there's something called qualified improvement property, not qualified leasehold improvement property. And what's important about that is it's now the definition to the bottom right of the slide. So to be qualified improvement property, the building, the construction needs to only be an improvement to the interior portion of a building, non-residential, placed in service after the building itself is placed in service. And then you see at the bottom right, there are some things that are excluded. This is a significant difference from qualified leasehold improvement property, because there the building had to be over 3 years old. It had to be pursuant to a lease. The lease had to be between unrelated parties. This is going to create a really, really broad opportunity for taxpayers to take bonus depreciation. And what felt weird to me as I read this rule was that you're going to have situations now where you could have 39-year property that's actually subject to bonus depreciation. Okay, so that's the bonus depreciation update. And next I want to move on for a few minutes and talk about the PATH Act's 179 update. So if things went the way they would have gone without the PATH Act, the 179 limit would have gone from $500,000 as it was before, or in 14. It would have dropped way, way, way down, and it would become virtually useless. So Congress made the following things permanent. Congress made permanent the $500,000 limit. So that's the max amount you could deduct under 179 in a given year. They made the $2 million phase out permanent. So that's the amount at which, if you start spending over that amount, you start losing some of your $500,000 limit. They extended the ability to use it, the deduction for for computer software, and then qualified real property was extended. What they're doing going forward is they're eliminating the limit, the $250,000 limit, and so you would be able to use all $500,000. It could all be made up of qualified real property. The statute is now inflation adjusted, and so presumably the Congress will come out, the IRS will come out with an inflation adjustment each year to reflect what the dollar is for 179. I want to talk a minute about what qualified real property is, because that's come up on prior webcasts. Qualified real property includes anything that's defined as qualified leasehold improvement property. So it's interior portion of a leased space. It could be qualified restaurant property or qualified retail improvement property. So that's what they're talking about. So again, the fact that they eliminated, or they're going to eliminate, the $250,000 limit is significant. So that's bonus and 179. So what I'm going to move on to now is
Rich, let me just jump in a little bit. What this gives us, as I said, last 3 or 4 years, we've been sitting with our clients saying, do we make major equipment acquisitions? Don't we make them? Will we be able to have bonus depreciation? And now we've got some structure. We've got a definition that will be relevant for this year. So you can make the meaningful decisions now. Look at your tax structure, look at your tax picture for the end of this year, and your equipment needs. And it's never a good time to buy equipment when you don't need it. But if you have needs and you can get a tax deduction by buying it and writing it off in the current year, there is true advantages to that. So we now have a chance to do some planning. And what I always get a kick out of is when I listen to Rich and when I read these laws and they talk about the permanence of these things, we all know that they're as permanent as whatever will happen in November. You know, we're going to have a new election, there'll be a new administration, but what we can certainly guarantee is that this is the law for 2016, and probably a pretty good shot that this will carry into 17, because by the time new administration gets in and looks at tackling tax law changes, hopefully it'll give us a year or two to plan. So we do have, while we like these terms permanent, we know that that's an IRS and it's a Washington, D.C. language of permanent. It's permanent until the next administration changes it.
Yeah, that's absolutely right. And just to piggyback off something Jack just said, you know, you think about that 2 slides ago where the percentages are going down. those things will affect your behavior in terms of what you buy and when. So for the time being, assuming nothing changes, you're in better shape buying things earlier and not waiting until 18, 19 when the percentages ramp down. I also think what Jack said is a good segue to the discussion on budget proposals, because of course nothing is permanent. So I want to walk through a few things that are on the table now that could change, in fact, some of the things I talked about. So on a positive note, we talked about 179. Right now the limit is $500,000, and there's a proposal out there to increase the limit to $1 million, which would be fantastic. The great thing about 179 is if you package together all these different ideas, you really start getting a lot of deduction. If you buy stuff, you use bonus, get a bunch of deduction that way, and then also throw 179 into the mix, you could actually end up in a situation where you're writing off virtually all of your fixed asset purchases or qualifying fixed asset purchases. Under the proposal, the phase out would stay at $2 million, which is okay. I like the $1 million increase. They would still index the limitations for inflation, and if this were enacted, this would be effective for taxable years beginning on or after 12/31/16. So it would be a 17 item. So that's 179. The next thing I want to talk about is a proposal that relates to 1031. This may not affect you directly, but could affect your clients. I found this really interesting. 1031 is such a basic blocking and tackling staple rule that many companies rely on, and what it does is it allows you to defer gain on the sale of property, and the property's got to be like kind, and really all you're doing is putting off the realization of that gain until a later date. Well, what would happen if this proposal comes to light or comes to life is that they would Congress would cap the ability to defer gain to $1 million per taxpayer per year, which would have a significant negative effect on the use of 1031. I'm going to skip over the second bullet point, which probably wouldn't apply to you. And the bottom bullet point just talks about the why. Congress believes that if they were to enact this, that Congress would generate $47.3 billion in additional revenue over 10 years. Now, it's interesting to me. I wonder how they come up with those numbers, because 1031 is just a timing issue, so I'm not quite sure how they count that. Okay, next, I want to talk a little bit. This is just a proposal, and how this actually shakes out remains to be seen, but this is a proposed credit that would sort of look like the new market tax credit, and the idea behind this credit is it would create an incentive for companies to move into areas that have been negatively affected by either a close down of a factory or maybe a shutdown of a military base. And this is the type of credit that you would have to apply for. There will be a fixed bucket, and there will be some sort of an approval process. Again, this is a proposal, and they don't know exactly how they would enact this, but I wanted to at least highlight this because I found it really interesting. It could create a tremendous benefit, and I wanted to at least give you a heads up so that you can keep your eye on the news as this thing goes forward. So next we're up to the IRS updates. As I mentioned before, what I want to do here is give you an idea or let you know about certain procedural items that came out.
With the IRS updates, let's get to our second polling question. Does your company use the percentage of completion method of accounting? Yes, no, or I don't know. If you could please respond to that. Okay, the votes are in excess of 80% do in fact utilize the percentage of completion method of accounting. Rich.
Okay, so the reason why we included that question is we have a lot of clients where for one reason or another, we have to do a Form 3115, and that's a change in accounting method. We'll have to do that for the company for tax purposes. the way you do accounting methods is you either ask for a non-automatic permission, which is very complex and there's an IRS user fee, and then on the other side there's an automatic change procedure. Well, the revenue procedure that existed in 2015 and before that included a provision that allowed taxpayers to make percentage of completion changes on an automatic basis. What this meant was a taxpayer could very easily fill out a form, fill out some statements, have no IRS user fee, and attach the form to a timely filed tax return. And it was really easy. What happened recently, I'd say over the last month or two, is the IRS published Rev Proc 2016-29, and this contains the list of items that are automatic changes, and it may change in the 15 version. So when I was going through it, what jumped out at me was the fact that they removed the provision where the IRS would formally allow an automatic change for percentage of completion. And I was actually just working with a client recently, and they were just about to file a Form 3115 for percentage of completion, and we had to go back and really revisit what we're doing. Now, there's a transition rule. If you haven't filed for 2015 yet, and you still have the ability to timely file your return, and you need to make a percentage of completion change, you still have one last bite at the apple to do it as an automatic change. But after the 15 filing season, if you need to make tweaks to your percentage of completion calculation for tax purposes, we would need to do that through the non-automatic procedures. And what that really means is it's due by the end of the tax year, whatever change you need to make. There's an IRS user fee, and the form is actually reviewed by a human being in Washington, D.C., which makes the process more painful. So I wanted to highlight the fact that there's this change in the percentage of completion method rules as it relates to accounting methods. There was a change for interest capitalization. There's and this isn't a change to the revenue procedure, but I just want to highlight the fact that if you had to make certain changes relating to retainages, you could make those through the automatic procedures as well. So again, this is not a change to the procedures, but I just want to highlight the fact that it's out in there. Toward the bottom of the slide, another big issue in my world is the fact that the IRS changed the form, and the form changed so that you now have additional information requirements. If you are doing accounting method changes for tax, you need to make sure that you're using the right form. Otherwise, the IRS will reject it. And the other part I want to highlight is there's an additional question in the form that requires you to fill out a statement that's almost like a miniature memo. You have to include rules of law and facts and analysis and attach them to these forms 3115. So the IRS has definitely made the process of filing these forms more difficult. And so if you're doing any of these, you want to make sure you're doing the right form and make sure you're attaching all the statements. The next thing I want to talk about, there's been a lot of talk over the last several years about the tangible property regulations changes, or regulations. This is just a short mention here that the IRS has finally got its ducks in a row. There are hundreds of pages of regulations. The IRS had no idea how they would audit this. They finally got their ducks in a row. And what they announced recently is that there's an audit techniques guide that will be released shortly. And so the IRS, we would expect the IRS to start hitting the streets and start auditing these tangible property regulation changes. As you might recall, these regulations affected not only real property, but they affected repairs to machinery and equipment. There are also de minimis rules which they'll be auditing. So this is a fairly broad topic, and we would expect to see some audit activity in this space. So now I'm up to the portion of my presentation that I called other construction-related activities. What I wanted to do here is talk about, maybe not updates, but there's some things I see fairly frequently in my practice that I think are worth mentioning. I think they're interesting. I think they're opportunities. so I just wanted to re-emphasize them. The first thing is the tangible property rules came out. They define what is a capitalizable project and not. And I want to emphasize the fact that 199, which applies to construction companies, uses or leverages on to the tangible property regulation rules. So if you're doing things that might not necessarily seem like construction, you're not building an entire building, you would still want to consider whether you qualify for 199. So definitely take a broader view as to whether you're, quote, constructing something for 199 purposes. Retainages payable, there's an opportunity to slow down revenue recognition under PCM by taking some things out of the numerator of the completion percentage and the PCM to accrual. This is for companies that aren't necessarily doing construction. It could be companies performing demolition, but something that's short of construction where there are ideas where we could slow down revenue recognition. My last slide, I just want to talk to for about 30 seconds. A case came out over the last 6 months. This was interesting. It was a land developer, and the issue was whether they could use the percentage of completion method. And what they were doing was they were developing lots and selling the lots. And the specific issue is whether these were qualified as construction contracts. And the court got into the fact that none of their costs related to the construction of a dwelling unit. And the court said they did not get to use the percentage of completion method. And the bad part of that is, they weren't able to use the completed contract method. The bad part about that was putting them onto the percentage of completion method caused them to significantly accelerate revenue. So with that, I am done with my portion of the presentation.
Okay, Rich, thanks very much. And we do see we have some questions. We'll get to those later on. We want to keep moving along with the program. Next, I'm going to turn over to Jesse Woodkey. Jesse is going to talk about research and development tax credits, which are incredibly strong and powerful tax of savings that's out there. But with that comes the peril that the IRS doesn't particularly like when contractors take advantage of it. So if you're going to do it right, get the documentation, and work with your tax preparer to make sure that you're well documented before you go. So Jesse, on that, we'll turn it over to you. Thank you.
Thank you, Jack. Many of you have already heard the good news, and that is that the R&D tax credit was made permanent as part of the PATH Act. And so, what the PATH Act really did was it retroactively extended the credit for 2015, and for 2016 going forward, it created some enhancements. And I want to highlight some of those enhancements. So for tax years that begin on or after January 1st, 2016, if you are an eligible small business, meaning that you have average annual gross receipts of $50 million or less, then the R&D credit would then be able to offset alternative minimum tax, or AMT. So that's great news. The AMT has been an issue in the past where construction companies, primarily those organized as S-corps, would have issues where shareholders are not able to utilize the credits because they were in AMT in their personal tax situations, and so those credits were carried forward. So for tax years beginning on or after January 1st, 2016, if you are an eligible small business, those credits will now be able to offset AMT. Any carry forwards you have from years prior to that date would continue to not offset AMT. They are still bound by the laws in the years in which they were generated. For large businesses, AMT continues to be an issue. So if you have average annual gross receipts over the last 3 prior years of over $50 million, then AMT is still something that needs to be looked at when evaluating the benefits of the R&D tax credit. Another provision that is really for startup companies, but if you are in the first 5 years of having gross receipts and those gross receipts are $5 million or less, in each of those years, then able to offset up to $250,000 of FICA employer portion of FICA tax. So that's a nice benefit for startups that are still in a loss situation and still, trying to get to the point where they're generating revenue. On the next couple of slides, we're gonna highlight some activities within the construction industry that might qualify for R&D tax credit consideration. We won't go over each and every one of these bullets, but kind of the catch-all would be this first bullet, the engineering efforts. So engineering and design efforts is really what we're focused on when it comes to the R&D tax credit in the construction industry. And these other bullets really just kind of highlight different types, specific types of design or design support activities. But if you're trying to build a LEED or a green building, that may add an additional layer of complexity to your engineering and design efforts. If you're doing building information modeling, BIM, and coordination systems, that also might lend itself to qualifying activities. In the next slide, again, we're looking at some examples here of qualifying activities in construction industry, and really we're looking at new or improved product development, which the product development within the industry is really the designing of unique building systems. It could be the electrical system, mechanical system. It could be the building envelope, perhaps. It might also include other activities within that effort, such as the building of mock-ups that are constructed and essentially destroyed in an effort to validate a design. So not only do product development efforts qualify, but also process improvements. And within the industry, there could be process improvements where we're looking at new production processes, construction processes, such as prefabrication. It could be that in that prefab effort, maybe your company is looking to develop new tools or machinery, fixtures in order to pre-manufacture certain assemblies. So the point here is that there's really a lot of different things that could qualify, and you want to go into a study and evaluate all the different activities that are going on within the company to identify which activities would qualify and which would not. On the next slide, we're going to get into what activities would qualify and how we determine if an activity that's being performed qualifies for R&D tax credit consideration. So what you're looking at here is this slide shows the FourPart test. And each part of this test has to be satisfied for an activity to qualify for generating R&D tax credits. So the first one is that there has to be a permitted purpose. And what this is saying is you need to have the intent to develop a new or improved product or process where you're looking to improve function, performance, reliability, and or quality. On the top right is the elimination of uncertainty. Here we're looking to eliminate uncertainty that exists at the outset of the project. That might be uncertainty as to the appropriate design of the system or a product or the process, or it could be that you're uncertain as to the appropriate method or maybe even your capability. Bottom left quadrant is where it says technological in nature, and what this says is that your activities must fundamentally rely upon the principles of hard sciences. That includes engineering, physical science, could be computer science, biological science. And then finally, the activity must also include a process of experimentation. And so we're looking at a period of time where substantially all of the activity constitutes elements of a process of experimentation, which might include the evaluation of one or more alternatives. It could be trial and error. It could be simulation, modeling, and other forms of testing. So that's that for the four-part test.
Okay, let's break here and just go through the next polling question. As best you can estimate, what percentage of your company's development efforts are performed under a contract with your customers? More than 75, 50 to 75, 25 to 50, less than 25, or this doesn't apply to your company? Okay, Jesse, you're seeing those results there. We've got majority 40%, they don't feel that this applies to their company, but then the rest is between 75, the majority between 75 and 50 to 75. So an interesting kind of mix across the board. Thanks, everyone.
Yeah, this is an important question because these contracts need to be reviewed in order for a taxpayer to claim R&D credits. And that's because we have to review these contracts and determine if, one, if there's qualified activities, but also to determine if the taxpayer has rights to the research, if they retain rights, and also if they have economic risk. And so we review contracts to determine if the taxpayer has the requisite rights and risk associated with the research being performed. So for rights, we want to make sure that you have rights to the design that you're developing, that you retain basically the intellectual property rights to that design, and also make sure you have economic risk, where we're looking at ensuring that it's a fixed price fee arrangement and other provisions within the contract to support that you have economic risk. So that's what needed to be highlighted there with that question. So what you're looking at here on this slide is these are the expenses that can be included in an R&D credit claim. So we're looking at the taxable wages of the people internally within the organization who are performing the qualifying activities. If you have a project manager, as an example, who is involved in the technical aspects of the design phase, we might expect to include, less than 100% of that person's wages. Maybe we determine that 30% of the project manager's time in the tax year is spent in qualifying activities. We could then include 30% of that project manager's taxable wages in the bucket of qualifying wages. We would do that for each employee at their appropriate percentage. We also would include any supplies that are consumed in the process of R&D. Supplies do not include depreciable property. It would be more using the example again of a mock-up. We built a mock-up, it cost $10,000, we subjected it to wind and water and etc. and destroyed it. Then we could include the expenses associated with those supplies. The last bucket is contract research. And here we can include up to 65% of the amounts paid to third parties who are assisting in our R&D efforts. Now your claim for qualifying expenses need to be supported with documentation, which we'll discuss on this next slide. I won't go over everything on this slide here, but what I want to highlight is that there's no specific record keeping requirement per se, but you do have to have sufficient documentation to support your R&D credit claim. And what is sufficient is maybe that's a moving target, but you need to have enough and good enough documentation to support a couple of things. One, that qualified activities are being performed, and two, that any estimates that are used are reasonable. We can use estimates in determining, for example, how much time we include for a project manager. If we determine that's 30%, we would want sufficient documentation to be able to support that that individual probably did spend roughly 30% of their time doing R&D. If you have concerns about whether your company has, quote unquote, good enough documentation, please give us a call. We generally find that you will have better documentation than what you might initially think.
Great. On that, let's take a poll. The next question is simple enough. Is your company currently claiming research and development tax credits? Yes or no? Okay. Again, it's pretty clear. 76% on the no category. And again, what we think is this is a very powerful, there are a lot of questions around R&D, and it's a good time during our interim planning, during your projections and pro formas, to have that discussion with your preparer as to whether or not we'll qualify for R&D. So, Jesse, I don't know if you just want to wrap up these last couple of slides in just a minute or so we can get on over to Steve, because we're running a little close on our time.
Yep, we'll do. So yeah, that last question, feeds right into, this slide, which basically describes our approach to claiming R&D credits and the study that we perform. Phase one is a feasibility where we estimate the amount of credits that we believe that the taxpayer may be entitled to. Phase two is where we actually go in and dive in and figure out exactly what those numbers are. And so there's a phased approach. There's no obligation for phase one. We don't charge a fee for that to determine if it makes sense for your company to move forward. The next slide focuses on common areas of audit focus, and it's important that you position yourself in the best possible position for that potential event in which you might be selected for an audit. And so what we find is that it's important that we establish a nexus between the qualifying project and the associated expenses that are claimed, that we have supporting documentation that establishes a nexus between the individuals performing the activities and the activities themselves, and also that contracts are reviewed. There have been a couple of recent court cases that really highlight the importance of reviewing contracts. So I'll move on to the very last slide, and this last slide really just is to point out that not only is there a federal R&D credit, but there are state R&D credits. Not every state offers an R&D credit, but many do, and many of them, most of them, piggyback off the rules of Internal Revenue Code Section 41, which governs the federal R&D credit claim. There are differences, some slight differences in how those credits are administered. Some you have to apply for before you actually claim credits. So there just are some differences that need to be considered. And the last point really is that when we go in and do these studies, we're able to identify a lot of other opportunities. Part of the process is interviewing people within the company and reviewing some financial information. And so in doing that, we're able to identify, Section 199 deductions, cost seg opportunities, state R&D credit benefits, and accounting method opportunities. And so that concludes my segment of the R&D credits.
Appreciate it. At that, we're going to turn over to Steve Nanos to talk about the 179D, and this is another very effective and powerful tool that too often is not taken advantage of. So maybe to set up Steve, I'll go right into this first question. What is your experience with 179D, commercial energy building tax credit deduction? Multiple choice. I've never heard of it. I've heard about the 179D. I'm not sure if my company has taken advantage of it. My company has and does take advantage of 179D. If you can respond to that, we'll set up Steve for his presentation. Okay, we've got quite a few of not a lot of people knowing about it, and or they've heard about it but not kind of implementing it on a real-time basis. So, good topic, Steve. Let's get into it. Because again, it's another thing I think is pretty powerful and not as IRS suspicious. Doesn't seem to have the same kind of zest for audits when you take the 179D. So
that's correct. We found a very, very low issue of audit, and when it is, it's a matter of an auditor not being aware of it that much, looks up the program, looks at reports, and follows along with the requirements, and everything's in the report. So it's gone through very smoothly, and it's brought some significant benefits to many people across the country. You're not alone if you haven't heard about it. It's been out there since 2006, but it's not unusual that people have not heard about it or heard a little about it. And as we're seeing here in the poll, very few have actually used it. So there's an opportunity there, and especially since we can go back retroactively, the opportunity can be quite large for many companies. So who benefits? There's two basic sectors the program covers. One is private sector buildings, and the other is publicly owned buildings. In the private sector, it's pretty straightforward. It's similar to cost segregation, where it's an immediate expensing of an otherwise permanent property, 39-year or 27.5-year property. So there's a significant net present value to moving that depreciation up to the current year. All of that's taken in the first year upon completion of the certification. In the public sector, it's actually a little different and a little better. It's a permanent deduction. The public entity cannot use the benefit, but the government still wanted designers of public buildings to be aware of energy efficiency, to use this as an incentive to make sure that they were considering that a little more intensely in their analysis when they design or provide specifications to a public owner. And what they did is they've made a simple form or a structure that says 1 or 2 pages, the benefit gets allocated from the public entity to the designer or design team. So as we move along from there, let's go a little bit more into the program. So what qualifies? It's not only new buildings, but also retrofits. It can be an addition. An addition can often be blended in with the existing building, and we can get the benefit for the whole building. It can be a simple retrofit for HVAC or lighting. Building envelope. Those are the 3 components that we look at. There's your heating, ventilation, air conditioning, your building lighting, and your building envelope. Envelope, of course, is your roof, your walls, windows, etc. And those are the 3 areas that are involved. Exterior lighting is not a component. So what is, as well, what is considered addition to that would be leased properties. Properties where you have a long-term capital lease, the lessee can also qualify for his retrofits if he's spending that capital. So it's where is the capital on the books? If that improvement was done by the building owner, then he would have that on his. If it was done by the lessee, then the lessee has an opportunity to take advantage. Next, as we go and look at types of buildings, we're looking at schools, colleges, universities, some public, some private. Post offices, parking garages, large retail facilities, warehouse. A lot of your distribution centers are extremely large square footage and offer a large opportunity for 179D benefits. Then we see some hospitals, the for-profit hospitals, hospitality industry, rental apartments, a lot of high-rise rental have taken advantage of this. Hotels are an excellent opportunity for 179D. It's important that you heard about 179 before. That D is important. 179 has some limitations, $500,000 at present, may vary from year to year. 179D is not limited. It does not go on a special depreciation schedule. The amount that you get goes right on your federal tax return as an other deductions line item. So it could be $10,000 and it could be $10 million. So When we do look at residential, however, for 179D, it's for more than 3 stories. So let's say 3.5 stories on. There's another tax benefit out there for residential properties of 3 stories or less, which you can follow up with CohnReznick later on. Next slide, we're looking at the next one. Oh, not here. Sorry, I'm doing mine and not yours. Benefit. So what's the maximum benefit that 179D offers? The maximum benefit is $1.80 a square foot. So if we're looking at a 100,000 square foot building, $180,000 of tax deduction could potentially be the benefit from 179D. When we're looking at contractors, a lot of the people online now are architects and contractors, design build contractors. We're looking at the group that provides specifications of energy efficient systems for the project. So it's a little different from, let's say, many projects you think of a designer as who stamped the drawings. The architect has his name and stamp on there. The mechanical, electrical, plumbing engineer might have his on. Structural and civil might have theirs on there. This is a little wider definition. You can be an environmental energy efficiency consultant. You can be a system supplier that works closely with the engineer and architect on providing system specifications, alternates. It's a very wide range, but a few of them are on the slide, and those are typically the key ones you'll see often are architect, engineer, design build contractors, and those are 2 of the top areas. You'll find a lot of energy service companies take advantage of this because that's their key focus. They're going in, saving energy costs, and therefore are the, let's say, prime position with the owner for designing the energy efficient systems. As we move along, our next slide, what's required to get that benefit from the owner? Obviously, a private owner, he doesn't have to do anything. He simply works with his tax accounting and consulting group, works with a company like us, gets the certification, and then puts the deduction on his tax return. On a publicly owned building, there's required that allocation form. It's a fairly simple form of a page or so, and it simply states that the government authority says you are a designer, we know you worked on this project, and we're going to confirm that in this letter. From that letter, then, that's all you need from the government entity. From there, the process moves along with us evaluating, or a company like us evaluating the project, determining the level of potential benefit, and then agreeing to move ahead, and you have a report. Now, there's a couple things that are different between public and privately owned buildings. For privately owned or leased properties, the program is retroactive all the way back to 2006. An owner can take it for a current year project on his current return. He can amend open tax years, but for any of those years, he can also choose to do a change of accounting form and take that benefit on his current year tax return. So it's very flexible. It allows you, if you're not profitable a few years back and you'd rather take it right now and not carry it forward, you can actually do that through the change of accounting form. For publicly owned properties, designers of public buildings are not allowed to use the change of accounting form. They must amend an open tax year or use it on a current tax year project. So a little bit less further back, but you can typically go back, figure for right now, about 2013 on for any publicly owned projects where you were a designer or part of a design team. So we lead right into a polling question.
Okay, yeah, let's get into our final polling question of the program. Since January 2006, what percentage of qualifiable projects have taken advantage of the 179D energy efficient commercial building tax deduction? So give us your best guess. Those projects that qualified, how many of you think actually took advantage of it? Less than 10%, between 10 and 20, between 20 and 30, between 30 and 50, and over 50. Looks like we got a pretty smart group here, recognizing that we have the advantages have not been taken.
I would agree. You know, even though the program has been around since 2006, very few companies have taken advantage. In fact, the actual answer is number one. It's less than 10%. few years ago, I would have probably said it was, from our information, it was just more closer to 5-6%. So there's a lot of opportunity out there, as you showed, not only on your company's projects, in general in the industry, when you're talking to clients, potential owners of potential projects that you may be involved in. This benefit is out there, and especially since we can go backwards, you have an opportunity to generate a lot of deductions on work you've already done. The program's a little different than the R&D and the others in the PATH, some others in the PATH Act, in that it has not been extended yet beyond the end of 2016. Now that doesn't mean in 2017-18 you can't go back to 2016 before. The good news is that it's been extended multiple times. It came out in 2006 as part of the Energy Policy Act of 2005. It was extended again for 2008. It was extended at the end of 2008 through 2013, extended for 14, and then again for 15 and 16. Recently there was indications of bipartisan support to extend it again, but we do not know when that'll happen. But we are, as part of the process, and I think the process shows up on this slide here, same as Jesse mentioned for R&D, it is a cost, no cost actually, process to evaluate projects, discuss projects with you, review plans, review your designs, and actually let you know whether or not the project looks to qualify, and if so, for how much. And from there, then you can decide go, no go. So that's the process. We move along to then getting the allocation form if it's public process project, skipping that if it's not, doing the engineering work, inspecting the site, preparing a certification report where it outlines and follows the 179D program exactly. Should an IRS auditor look at it, he can just follow right along with the notices and the report. And that's the process. Happy for your time. Thank you so much for listening to 179D.
Great. And we do have some questions, and we're going to run up against, we're at 12:57, so we've got 3 minutes into the hour program, but we will stay on a little bit longer to answer the Q&A, and anyone who wants to stay on, please feel free to join us. And then I think before we get to there, obviously we've got the firm's disclaimer that our legal department says I have to say, that we're subject to certain disclaimers and limitations on what we've shared with you today. So, Rich Back, the first question I think kind of ran to your area on the 179 phase out. Began or ends at the $2 million? If it begins there, where does it end?
All right, well, it begins at $2 million, so once you spend $2,001 or dollars, then it starts chipping away at the $500,000 deduction. So by the time you hit $2.5 million, then you would have wiped out your benefit. So that's the way that works, Jack.
Okay, great. And then can you, I guess there was the one on the overall, the 1031, what is the long-term benefit, the step up in basis?
So 1031 is a provision that allows you to defer gain on the transfer of property. Ordinarily, the IRS would say, what did you get? What did you give up? What was the basis in what you gave up? And they would calculate gain and you would recognize or realize the gain at that point and pay tax on the gain. If you're going to like-kind property, so the benefit, to answer the question, is the ability to defer that gain. As far as basis, if you didn't put any more cash into the deal and you just went like for like, traded out properties, you basically get a carryover basis in that property, and that's what causes you to recognize that gain later. So you're not actually getting a basis step up. The only time your basis is going up in a 1031 is if you're bringing or adding additional cash to the deal, for example, by financing, maybe you're moving into a bigger property or something like that.
Great. There's one question here, and I think I'll take a shot at it, and then Steve, please fill me in on it. How would you describe an ideal candidate for a tax credit? So from a 179 standpoint, take a look. If you're building a building and you talk LEED, you talk silver, gold, you talk any of the kind of the buzzwords in the industry today about energy efficiency, stop and talk to your tax providers about whether or not you're taking advantage. So if you're building any kind of in the private, we need to understand a little bit more, but certainly in the public sector, if you're doing a public sector building and you've got any kind of energy efficiencies and you're involved in the design, the architect, the construction, or some of the specialty trade suppliers to that, and nobody else on the job is taking it, you're the first, chances are you can get it, correct?
Exactly. It really just takes the question to be asked of, hey, I did this work, can I qualify? And from there, everything else flows. And as Jack mentioned, equipment suppliers, sometimes they're doing it turnkey, sometimes they're just supporting the engineer, and other parties aren't interested, or they're happy to bring that company in as a part of their team and share the benefit. So it really is wide-ranging. The benefit, as one project that shows here, was over $4 million for one designer.
Yep.
So there's a lot of potential here, and Jackie had it just right.
And Jesse, to you on the research and development tax credits, it's going to come to the contractor that A, has their books and records in order. I think R&D tax credit is much more of a very high risk for audit with the Internal Revenue Service. So if you are a contractor that is conservative by nature, that has already been audited, that knows you've got a clean set of books and records already, then it's time to look very aggressively at the research and development tax credit. And if you're doing work that when you start to talk about BIM technology, when you talk about something that your company hasn't done before, doing some kind of a new process or a new procedure, that's time to have those discussions. Jesse, any other concerns there on who's the right candidate for an R&D tax credit?
No concerns, but I agree with what you said, and really we're here to listen to your individual unique situation, and we can advise you on where your risks are and where they maybe are not. And so if you have a concern about something that was said in this presentation or that you've heard out on the street, we can listen to your unique situation and let you know if that is a risky position or if it's not.
Good. Okay. And then there's a question kind of back to back is, with the 179 energy efficiency credit, does that give you the ability to share that back? Have we seen where the public owners have asked for that to be shared back? Does it give you a competitive edge if you are the designer, or if you are a contractor, and go to offer the agency the chance to share with them some of the energy efficiency deduction?
There definitely is an opportunity to share it back. There's a program out there that we work with. Others may have a similar program that does offer a charitable deduction for the owner. What you'll find, what our history has been, is about 1/3 of the owners will just sign the allocation. They're happy to have you on, you've supported them, they're happy to help you out, it's a tax matter, and they simply sign it. 1/3 are just like this item, where they say, well, yeah, it's great, hey, is there anything for me? And that could be something like a small design study if you're an architect. It could be a straight charitable deduction through the program that I mentioned. It could be a set of filters if you're an HVAC supplier, designer. So there's a lot of things that you can do, but that is one avenue. And maybe 1/3 or less are just going to be trouble. They're just not interested. They don't have time. They don't answer. And you move on to the next project. But even those, with a little effort, can often be turned around, and we can certainly support that.
And to the point of any of these, get us involved up front, yes, in the bidding process, in the identification of new type of work that you're going to bid, is the time to have the discussions to make sure you're going into that knowledgeable and understanding what the advantages and what the risks might be. There's one last question. We had one question about the states where there's R&Ds. We'll answer that offline, or if anybody else wants, actually we'll include it in our package of information if we can come up with a list of states that have R&D tax credits. And then, can the research and development credit that's reflected on a Form 1120-S be used to offset the AMT on the owner's 2015 Form 1040? Jesse?
Yeah, 2015 R&D credits cannot offset alternative minimum tax for the individual shareholder. Now, they would not be able to. For 2016 going forward, if the tax year begins on or after January 1st, 2016, then those credits that are generated in that year would be able to offset AMT. Okay.
That is that's the list of our questions. We very much appreciate it. It seems like most of the people have stayed with us. That's great. So hopefully you all found it to be topical and of interest. And please reach out to your CohnReznick tax preparers, your audit team, to have discussions about any of these in more detail if you'd like to. And again, thank you for your time, for your cooperation, and for your interest. Have a great day.